I want to turn now to the markets where, despite the British exit worries, the Dow reversing earlier losses today. We peaked into the positive territory. We were down 127 at the low of the session. Now, there are certain trends that are still going on, including the flight to safety. Your 10-year yield hit a low today. That's also reversing. But remember, that's coming off of an all-time intraday low. Investors have been turning to gold and silver as well. Gold at a 2-year high, silver outperforming that. Want to bring in market pro Scott Martin. Scott, let me tell you what I'm telling my clients, that good news is good news. Last week we saw good news on manufacturing 2 days in a row. The market woke up out of a sleepy slumber and rallied strongly. Today we just got the ISM non-manufacturing data. That's where I pegged this turnaround to. Do you see anything else going on beyond that?
I think you're right, Charles. I mean, I see this range-bound market that tends to trade up around, what, 2,100 on the S&P and then maybe fall back to 2,000 and kind of hang in there. I think you're totally right, though. I think good news is definitely needed news these days because you've got the Federal Reserve that can still be dovish with the Brexit vote, with all the troubles overseas, with the low interest rates everywhere. But what we don't want to see as market participants is the economy fall off a cliff because, let's face it, the Fed doesn't have a ton of bullets left. The Fed has been telling us things are getting better. Some of the data says it's not.
Isn't that the narrative, though, even before the British exit vote, but even more so now? Japan with negative interest rates and the yen is going to, all-time highs. Germany with negative interest rates, and you still see a slippery slope in the EU. Maybe central banks have simply either run out of bullets or their bullets don't matter anymore.
I think that's the key point. I think the central banks have lost all faith in credit, or at least the market's lost all faith in credit in what the central planners can do, Charles. And that's a dangerous game because what's happened in the years leading up to where we are today, the central bankers have been the ones that have helped prop up these equity prices. They're the ones that have destroyed these currencies and tried to stimulate exports and help the banks. So the day that the central banks can't influence these markets anymore, you're going to have a new regime on your hands.
Let me ask you about the range boundness you talked about. Certainly, we've been in that area for a long time. Do you tell investors wait for this to be broken either on the upside or downside before making your next big move?
Yeah, we're telling our clients to just temper your expectations with regards to, say, equity returns. I don't think there's a lot left in the equity market in this year, at least until we get past the presidential election. But I do think there are other areas that will provide that good risk-adjusted return. You talked about it earlier. We've been talking about gold on this show all year long, as you know. That still continues to be a big asset class for us. And don't fear your U.S. bonds. I know the 10-year Treasury at 1.3% sound crazy, but I think we're going to 1%. So 10-year bonds, to me, are still a good buy here.
All right, Scott Martin, thanks a lot, buddy. Really appreciate it.
See you, buddy.
All right, the biggest